Hi, this is Sarva. Everyone wants to make more money, right? So people invest in different investment opportunities. They buy gold, they invest in real estate, or simply they keep their money in their savings account, or they put in fixed deposit, or they buy stocks or invest in bonds, right? So in this video, we will talk about mutual funds. What are mutual funds? How the entire process works, right from investment and how it goes, how the return comes in, and how the cycle goes and works, whether one can invest independently or he needs some company's help, what are the types of funds, and what are the pros and cons, what are the risks involved, what are the various terminologies associated with mutual funds, which is important for the investors to understand. Yeah, we will see some illustrative examples also. Here we go. So before we jump into the various types of mutual funds, it's important to understand a few terminologies that are associated to mutual funds, right? So one is asset management company, right? This is also known as mutual fund company or money management firm. So asset management companies, AMCs, are firms that pool funds from various investors. Investors can be individuals or institutions, right? They collect funds from investors and they invest in various securities. So the next is asset under management, AUM. Asset under management refers to the total market value of the assets that a mutual fund manages at a given point in time. So this is the total market value of the assets of a particular fund. Right, next one is a portfolio. Portfolio is a mutual fund portfolio is basically a collection of investments made in different mutual fund schemes. So when we talk about asset under management, it is at a company level, whereas the portfolio is at an investor level. Next is net asset value, NAV. NAV is nothing but price per share value, a value of one share, that is NAV in short. So NAV is calculated as assets minus liabilities, this will give a net asset, you can say, divided by total number of outstanding shares. So when you say net assets divided by total number of outstanding shares, we will get price per share. So when you say assets, it includes the total value of the fund's asset, cash, securities, etc. When we talk about the liabilities, it is basically any payment that is pending, right? So charges, fees to any associate entities. So another important terminology is expense ratio, right? So expense ratio is calculated as the total amount of fund fees divided by the total value of the fund's asset. So expense ratio is basically the fund management company will charge some amount to manage the funds, right? It may be for administrative cost, or it may be for management, or it may be operating expenses. It can be anything, right? So it will be one small percentage of the total fund's assets. So let us take an example. If the total fund fee equals to $100 and the total fund assets equals to $20,000, then the expense ratio will be equal to 100 by 20,000, which is equal to 1 by 200, which is 0.5. So in this case, the expense ratio is 0.5 percentage, right? 0.5% you can say. So good expense ratio for any investor is somewhere between 0.5 and 0.75. If it is above 1.5, then it is considered as high, because at the end of the day, this percentage is the depiction of the amount that will be deducted from the investor before giving him the returns, right? These are the charges, right? The percentage of charges. So lesser the expense ratio, better it is for the investor. So another term is entry load. There are a couple of terminologies like entry load and exit load. Both we need to understand, because these are again charges levied on the investor, right? So the entry load is a charge or commission to the mutual fund company by the investor during the initial investment purchase. this is to cover cost of distribution. So entry loads are charges that are calculated as a percentage of NAV. So assuming that the NAV is $100 and the entry load is 1%, then the entry load value is $1. So per unit price will be fixed as $101 while selling, right? So while units are allocated, the entry load is added to the NAV. Next is exit load. So exit load is basically a fee charged by the mutual fund houses if an investor exits a scheme either partially or fully within a certain period from the date of investment. Suppose the scheme is for maybe 1 year and the investor wants to withdraw the money within 2 months or 4 months, then there will be some charge that will be levied on the investor, and that is the exit load. So exit load is calculated as total number of shares or units into NAV. So basically it will give you the total value of the asset into exit load percentage. So if the total number of shares are 200 and NAV, that is per share value, is 400 and the exit load is 1%, then exit load will be calculated as the total number of shares, which is 200, multiplied by share value, which is 400, multiplied by exit load percentage, which is 1, so 1 by 100. So that equals to 80,000 by 100, which equals to 800. So exit load is 800 in this case. So next is another term called redemption amount. Redemption is the process of selling the shares back to mutual fund company, right? So when the investor wants to withdraw, he wants money, he will sell the shares back to the mutual fund company, right? So what happens is this redemption value will be calculated as the total value payable to the investor, investment plus returns, that is units bought multiplied by NAV minus exit load, which equals to 80,000 minus 800, which is equal to $79,200. Yeah. And if there are any other liabilities, anything pending that is to be deducted from the investor, that also will be deducted. Next is direct plan. So the direct plan is the type of mutual fund that is directly offered by the asset management company, AMC. Right, when we say directly offered, this means that there are no no intermediaries in between. There will not be any broker, any distributor or advisor. So this means that the company, mutual fund company, does not have any need to pay any fee or commission to the intermediary. So this will be beneficial to the investor. So next one is a regular plan, which is the type of mutual fund that is bought through an intermediary, right? So initially when we talk about the direct plan will be suitable for people who have good knowledge about the mutual funds, the asset management companies, and the basic idea about some stocks. They can invest in direct plan. You know, they will be in a position to use the direct plan because they are confident of the market knowledge they have, right? So next is the regular plan. As we saw, the type of mutual fund that is bought through an intermediary. So here the investor who does not have any knowledge about the mutual funds but still wants to make some investment into mutual fund, which he wants to have good safety measures and also good investment returns, right? So those people can use a regular plan. So these people will be going through broker, distributor or advisor. So in this case, what happens is the investor goes to the intermediary, and the intermediary on behalf of the mutual fund company gives advices to the investor, and based on his advice he will be investing the money. So in this case, the intermediary will charge some fees or commission for selling the product of the mutual fund company. So this mutual fund company will pay the commission to the broker, and in turn they will deduct this money from the investor. So the next one is SIP. An SIP is nothing but systematic investment plan. It is an option offered by the mutual funds to investor to invest a fixed amount of money at predefined intervals, which means that suppose the investor wants to invest $100 every month, the investor can do. This option or facility enables the investor to do so. This is applicable or available for a selected mutual fund schemes. So the next terminology is a lock-in period. So when we say lock-in period, certain schemes, mutual fund schemes, have this lock-in period, which is defined as the investor cannot redeem the units before completing a predetermined period from the date of investment, right? Say, for example, if an investor invests in mutual fund scheme on 1st of January and there is a locking period of 1 year, then till the December 31st of the year, he will not be able to withdraw the money. For example, we have ELSS, right, which is equity linked savings schemes. They have 3-year lock-in period, which means if you pump in the money, you invest the money and wait for 3 years. Before that, you will not be allowed to withdraw the money. But the advantage of this scheme is they provide tax benefit under section 80C. So before we continue, if you have not subscribed to my channel, please do subscribe and press the like button at the end of the video if you like it, and press the bell button so that you will be notified whenever I produce my next video. Let's continue. So what are the types of mutual funds? There are three major types. One is equity mutual fund, the second one is debt mutual fund, the third one is hybrid mutual fund. Right? So there are a couple of other types of funds which we'll see a bit later part of the video. So what are equity funds? Here the assets are invested in the stocks of the companies. The returns are considered to be good in the long run. The risk is kind of bit high, right? So within the equity fund, there are subcategories like large cap equity fund, mid cap equity fund, and small cap equity fund. So when you say large cap equity fund, here the assets are invested in top rated, reputed big companies, right? You can say that the top 100 companies, the corpus of 80% of the corpus are invested in the top 100 companies. So the returns are good in the long run. The risk is considered to be low. These are considered to be safe investments. Then we talk about the mid cap equity fund. Here the assets are invested in mid-ranked companies, the companies which are ranked between 101 and 250. Here there are potentially they have good returns. In terms of risk, it is lower than the large cap equity fund, but still it's volatile and it belongs to high risk category. Then we have got small cap equity funds. Here the assets are invested in small companies which are ranked below the top 250 companies. Here the returns are high and the risk is also very high. Right, so we talked about the equity fund. Next is debt fund. Debt fund is also known as bond fund or fixed income fund. Right, basically here the assets are invested in corporate and government bonds or corporate debt securities. Right, so fixed income is kind of assured. The returns are really good if the investment is for more than 3 years. In terms of risk, debt fund risk is lesser than equity fund. However, it is not risk free. There are risks like credit risk and interest risk. Credit risk nothing but when the investment is made in securities which are low rated, they may go default. In terms of interest rates if it goes up, then the value of the bonds will come down. We can go to the further details, then the video will be too long, so I will make a separate video on the exact calculations and how the returns work, right? Where to invest, how much we can expect, what is the locking period, how long should be the investment in each category of the fund to make the best out of the investment the one investor is making. Yeah. The next is hybrid fund. As the name suggests, here in this mutual fund scheme, the assets are invested largely in equity fund and a debt fund. Sometimes in other asset classes also, depending upon what is the very objective of the underlying investment scheme. So in terms of returns, the returns are higher than debt funds, whatever the returns we get from the debt fund, but it's slightly riskier. In terms of the actual risk category, it falls under moderate risk category. Yeah. Okay. The next one is solution based mutual fund. Here, when the investor wants to accumulate certain amount of money for a particular reason, right? For example, for retirement, they want to have money, or they want to accumulate money for the higher education of their children, or the marriage of their son or daughter, right? So when someone is okay to invest in a long term for a particular specific objective, then they can go for this particular scheme, right? Here in terms of returns, the returns are really good because the investments are long term. In terms of risk, it's a limited risk category, we can say. So we have seen four categories of funds. One is equity fund, second one is debt, the third one is hybrid, the fourth one is solution based, the remaining fifth one is other category of funds. These are the five categories given by SEBI, Stock Exchange Board of India, which regulates capital market basically. You can also visit moneycontrol.com, which is a financial and business portal which is top rated. You will be able to find many useful information related to market analysis and the expert opinion and market coverage as well. This video is not sponsored by anyone. I'm not advertising any website or portal here. This is just my personal opinion. That's all I wanted to cover in this video. Please put your comments and also let me know any specific topic you would like me to cover in a separate video. Please subscribe and like the press button if you like the video, and press the bell button if you want to get notification whenever I produce my next video. This is Sarva signing off. Be happy. Love you all. Bye-bye.